And good morning, everyone. My name is Randy Price. We are the Price Group, and here we go with our market update, September the 27th, 2022. Our ongoing goal is perspective and also education to help you in the day-to-day intricacies of both the stock and the bond markets. So with me is Matt Price. We are a family-owned and operated investment boutique. 45 plus years of experience. We follow a fiduciary standard, and fully over 80% of our clients are retired. So this is what we do on Mondays. This is what we do on Tuesdays, Wednesdays, Thursdays, and Fridays.
So a little bit about us.
About the Price Group. Matt, tell us a little bit about the Price Group.
Yeah, Randy's too humble. I'll brag on his behalf. I have a few awards from Barron's, Forbes, Financial Times. If you've been getting our emails with any regularity, you're probably familiar with the Wealth Coach podcast. We believe education is really important. Both Randy and myself are CFPs, certified financial planners, and then we both went to Wharton to get our CIMA, certified investment management analyst designation. So we're continuing that. Maddie Kearns, who's been with us for now about 3 years, also a CFP, which we are really proud of. A little bit about our firm. I know we have quite a few clients on the call that are familiar, but a few that might not be. Steward partners, based off the biblical definition of stewardship. We serve as a fiduciary. We think that's really important from a standpoint. We're not owned by a bank. We use Raymond James as our custodian, meaning where client assets are held. They've been a great a vendor of ours. We'll be rolling out a few new custodial options to clients here in the coming months, maybe early next year, just as an option. So not a change, but just an option for clients as well.
Okay, a lot to unpack here as we get in sort of the meat of the matter. Deciphering market messages, and certainly it has been a garbled year of transmission, has it not? The message of the market has been unprecedented. What we've had, don't have to tell many of you, is a tough year for both stocks and bonds. Some of the worst performance year to date in history, starting from the left as we look at the slides there. S&P 500 worst start since 1970. Ouch. Bonds worst start to a year on record. Double ouch. And put those two together, and even diversification benefits have been limited. Typically, we talk about bonds being the ballast in the boat, and again, it's not been a good year for either stocks or bonds. Now, let's get into a couple of definitions. Bear market. Bears are bad, and by definition, a bear market is defined as a period in history where the market is down more than 20% or more. And so by definition, we are in a bear market. But to us, we're going to put a little bit of clarification on that. To us, a true bear market in the traditional sense lasts more than 9 months. And obviously, we're just finishing up September. That would be 9 months. Going back to 1949 to 1956, a big bear market for the country. 2000 to 2008, in each of these two periods, the markets were down over 50% over a number of years. So it may not be a popular opinion, but we feel like this is a pullback, a severe pullback, if you will. But we're still in an ongoing secular bull market. A lot of things in play that could allow stocks to go higher. Obviously, this is political season and a lot of stuff going on there. But we've done some research. We've gone back and looked at the if you will, what do bear markets look like? Typically, there are about 27 sessions where we call it a selling stampede, where the market goes down. So the timing today is right for a reversal. As we look, the market is positive, but we're not willing to just call that yet. But stampedes typically are over by this time at 27. The average has been 17 to 25. And perhaps the most interesting thing for Matt and I has been we've got CNBC on in the kitchen, and sometimes as we walk in there to get some water, you hear these guys, and the pundits never saw this coming for the year, but yet they're on there telling you how to invest and what to do during this unprecedented period of time. So anyway, it is what it is. As we go to the next slide, and our call, again, going to a definition of what is a recession. A recession is technically 2 straight quarters where the market, where the gross domestic product, the output of the country's goods and services, does not grow. In fact, it shrinks. And a recession could be sort of mild, it could be sort of medium. It's those really nasty recessions that we're looking at. So again, as we tweak our definition, our call, no traditional recession yet. It's hard to see the economy going into a recession this year. The market is down, but we've got a robust labor market that probably will ease up a little bit with perhaps some layoffs and some of the stuff going on. Corporations have healthy balance sheets. That means a lot of cash. And we still have some tailwinds from reopening on there. But see there, bottom left, job creation, and then elevated cash positions, TSA screenings at a post-COVID high, restaurant bookings, hotel occupancy, weddings. I did my part this weekend as we just got the youngest of our 5 children married. So our family's one of the 2.5 million expected this year. You've got concerts and a lot of people driving, etc. So sort of an interesting time as we talk about recession, but in the traditional sense of recession, our call, no recession yet. This helps explain this a little bit more. If you again think about the output of all the goods and services in the country, the GDP, the gross domestic product, that is the measure for whether we're in a recession or not. Consumer spending up, wow. Business investment up, okay, very good. Government spending down, that's good. And then we're down a little bit on net exports. But again, this sort of paints the picture, if you will, on a different time here, as the government has been in the extreme on printing money and spending money, and so we call that the sugar high lots of times from an influence on the economy. And now we have inflation, and now we have some disturbances in the markets. And if you've been with us for any length of time, you know this is something that we've talked about. And yes, it's surprising on the way it's happened, but anyway, it's not surprising in many ways as well.
So Randy took the good news, no recession now. He left me the fun slide, potentially a recession 2023, maybe 2024. Let's take a look there at that middle chart, the Fed fund rate potential move to what we call the restrictive state. So the Federal Reserve, just to review, they control the really short-term interest rates, maybe the yield of the cash at the bank, but more importantly, what these banks essentially, their cost to quote unquote buy money to lend it out. And as we sit today, we're at the very high end of that neutral middle yellow band, or just right in the very bottom of the restrictive, the red band on there. So we've seen a real rate hike that we haven't seen at this caliber or this pace dating back to the 70s. And the reason for that obviously being that inflation is running at its highest clip in quite a few decades. So Mr. Powell has made the decision that he wants to get this under control. We think that's good. Has there been policy error? Well, time will tell on that front, but we do think next year, maybe into 2024, no one knows for sure. We do think there would be a mild recession in the traditional sense, like Randy mentioned, where the consumers do have a pullback in spending. Up to this point, we just haven't seen that yet with the consumer. If that is the case, we don't necessarily think it's going to be a deep, dark recession. We say this all the time, but humans are linear thinkers, Randy and myself very much included. And what we mean by that is if it's rained for the past 10 days, we think, oh my goodness, it's going to rain forever. And so when we think recession, we think 2020, where the economy, the world economy as a whole, just literally was shut down for about 60 days. Or we think prior to that, the most recent recession being 2008, 2009, a financial crisis. But we think this one would be more mild. The reason for that being that, like we mentioned earlier, the consumer is in a lot more of a healthy position. If you look back to 2007, prior to the 2008, 2009 debacle, the consumer was way over levered, didn't have a bunch of cash on the balance sheet, and as a whole, the consumer was not in a great spot. Same thing with a lot of companies out there. Companies were not in a good spot, and actually just the opposite is true now. You see a lot of these companies flush with cash, and same thing with the consumers flush with cash.
So if we look at what's going on here, inflation deaccelerating, great news, a potential game changer, drum roll please. We're going to look at 7 signs here to believe that inflation pressures could cool and a less aggressive Fed. Back before we start talking about inflation, let's look at just the sort of what's been reported in the press. You see signs that inflation is 8%. Okay, that means that year over year, or in a short period of time, maybe quarter over quarter, based on things going up in price, that inflation, the consumer price index, is 8% higher. Now, the key is what happens going forward. If things settle down and go level, then that inflationary pressure has cooled. Obviously, it's not for those of you that have studied the Federal Reserve or know it's not unusual for the inflationary pressures to ebb and flow as the Federal Reserve ebbs and flows on tightening or loosening with some of the tools that they have. So 7 signs, and we believe inflationary pressures could go down, they could cool. A normalizing money supply growth, well, you could do a whole book, a whole a webinar on this. Obviously, the money supply has just exploded and has to come back to somewhat more normal over time. Unprecedented inventory growth. You see the line there, total retail inventories ex auto, and the automobile industry has obviously been sort of an outlier with the chip shortage and this sort of thing. And sort of leading into that, auto prices are set to come down. It's been a perfect time if you're in the car business because you're getting full price or even more on every car that you sold, and that could very well come lower as some of these chips come back more into availability. Number 4 of the 7 signs, you've got falling freight costs. Obviously, petroleum prices, oil going below $80 a barrel has something to do with that. But also, if you're renting a ship or you're renting any sort of rail transport, you're looking at saying, you know, what is coming in the future? Is the economic activity going to stay as strong? And so you're not only making short-term decisions, but long-term decisions on what you're going to charge for that ship, etc. You've got semiconductor prices peaking. Samsung slashes orders on inflation and inventory worries. You got falling fertilizer prices. That obviously is a big portion of what food costs. And number 7, the economically sensitive commodities are falling. So you know, they talk about Mr. Copper being one of the best tools to look at that, and that copper is used for so many things and is a really good indicator of where the economy is going. So potential game changer, inflation is decelerating. We think it decelerates toward the 3% level next year. There's a political incentive to drive prices and prices lower as well. And there's pictures worth 1,000 words, the path of inflation. And we sort of got spoiled. Inflation between 1 and 2% from the period 2008 all the way through 2020. And then voila, we get the big spike caused by a number of things starting in 2020. And the $64,000 question is, where do we go from there? But again, based on the people we listen to, based on our information, we think inflation does move lower, does decelerate for there. And you've got, gas prices, the economy, bills and groceries, so on and so forth, listed there as a political incentive. And the big political incentive, number one on the list, what people are going to be looking at when they go into the voting booth is inflation. So anyway, for what that look at the upcoming elections is worth as well, there we go. Inflation, we think, will decelerate. Again, talking about the midterm elections, it's the top focus of voters, and 26 House seats are on average are lost during the midterms, and 85% of Americans believe that the U.S. is on the wrong track. Now, here's the interesting thing about that last statistic. If you feel like that the country is on the wrong track, not being political here, you're probably going to be a little bit more judicious in your spending, whether you take that extra trip, whether you make those extra gifts to charity, to children, whether you trade cars as often, whether you possibly do an add-on to your house or that sort of thing. I think a lot of that has been speeded up on some of the housing stuff because interest rates were so low historically, and especially after inflation. But now that interest rates have come up, we think that's going to be more of an issue on that. But there is a political incentive to drive the prices lower.
So another piece of the pie, rising oil prices hitting the economy. You can see there on the right-hand side, depending on how much money you make each year, there's a different threshold for how this is affecting you. But I'd say we think the most important graph here on the left, when you look at the inflation adjusted price for gas, we haven't broken records. So we kind of think in absolute terms. Oh my goodness, gas is $3-4 a gallon, whatever it is. But when we compare that to the peak back in 2007, on an inflation adjusted basis, it is not the highest on record. So you should see gas prices here in the next few weeks continue to fall, just with crude oil following, and the gas prices typically lag by a week to maybe 3 weeks. So this will have some type of help as we are essentially rooting for inflation to move lower, and this being a big component of that equation. So we don't expect oil prices to really get out of control from here. We think things should level off. OPEC and the U.S. are keeping pace with the lost Russian production. There's been some articles I'm sure some clients have read where certain companies the Russian oil is still getting sold, but it's going through another party, almost a holding company. And then these other countries feel comfortable because they're buying it from a quote unquote holding company, not directly from Russia. But anyways, production is keeping up with the demands. And you can see there on the right, the crude oil future curves, which are what are the expectations for crude prices in the future, look to be pretty stable in that $70 to $80 range. So this is a busy slide, might just look like one of my kids took a pen and started drawing on this page, but is the worst of the bond rout behind us? And we think the answer is yes, not until I'd say probably in the last few weeks. The bond market as a whole has not thought that inflation is going to continue to move higher. And I think we've seen a reversal of that here in the past 2-3 weeks. But with that being said, the Federal Reserve is in, we wrote a blog about this last week, so this might be redundant for some of you, but the Federal Reserve is increasing short-term interest rates with the hope that it will mute inflation or make it harder to borrow money from a bank or more expensive to buy a house. And they essentially want to curb, not all, but a portion of that economic spending to mute some of these inflation numbers. And when we look back at the history of the Federal Reserve, there was a real philosophical change right in that 2008-2009 time period. And so we are of the opinion that raising short-term interest rates is not nearly as valuable of a tool as it was pre-2008. Now, what does that have to do with what we're talking about here, the bond market, the rout likely behind us? We think that inflation is more closely aligned with the money supply. We had another blog on that a week or two ago, and you have seen over the past year the money supply start to move lower at a pretty quick pace, and the inflation figure lags usually in that 6 to 18 month time frame behind what the money supply is doing. So with that being said, we think inflation will start coming lower. The bond market typically peaks 1, 2, 3 times sessions before the Federal Reserve increases their interest rates to their max level. So if the Federal Reserve planned to increase interest rates, pick a number, 3 more times, well, the bond market typically has its highest interest rate, historically speaking, prior to the Federal Reserve finishing their increases with the short-term interest rates. So a lot of information there. We have a 10-year year-end target below 3%. That's gotten a little less likely with us. When we put this presentation together a week and a half ago, interest rates have continued to move higher at a quick pace, but we will see what happens.
So the interest rates higher, what has that done? If you own some bonds, you know that interest rates up, bond prices down. But it also provides an opportunity. It's made bonds more attractive, long-awaited opportunity for many people to generate some reasonable income. Typically, the average retiree needs 3, 4, 5% from their portfolio to make ends meet, to get raises on a regular and consistent basis, etc. There on the bottom left, Treasury yields were unattractive at the year end, and we move. You can see how much they've moved from where they were on 12/31. So anyway, if the bottom figure, if they go to 4% on the 10-year Treasury, that's 2.5% higher, and that would mean a total loss of 19.7% on the 10-year bond. But the most generous yields we've had in over a decade. The light blue there are the investment grade bonds, the black dark blue, the 10-year Treasury, and then potential return over the next 12 months. The base case, if the interest rates come down by 0.35% or 35 basis points. So again, been a difficult period to be a bond market investor. And here we go going forward as well. Also an attractive entry point for municipal bonds. As we talk to people, we don't see many people that feel like tax rates are going to go down, which means that tax-free bonds, which typically yield 70 to 80% of what the taxable bonds yield. But what we're seeing is tax-free bonds yielding every bit as much as the taxable bonds, 100%, if you will. But strong fundamentals, cities, towns, school districts, whatever, have a lot of money. They've refinanced debt, so there's very attractive valuations on tax-free bonds, despite a very, very rocky start to 2022. And we've been asked the question, I don't understand what gives. And this to us was one of the most perplexing things with regards to the market. But a lot of people decided, hey, we're going to sell our tax-free bonds. And so a lot of money moved out of the market. The middle chart there shows if you have a AAA rated tax-free bond, AAA the highest rating at almost 5%. The 10-year Treasury, it yields more than the 10-year Treasury at this time. 10-year Treasury is some higher, so that has narrowed in the time since we put the slide together. But 5 reasons we still think tax-free bonds make sense. Attractive yields. State and local governments are in great financial health, sort of said that. Summer season, net negative supply, which is help. Traditionally, tax-free bonds have had a much lower default rate than corporate bonds and less credit risk than other fixed income sectors. So you see some mutual funds actually buying tax-free bonds in taxable bond accounts.
So here's the question we get the most frequently: where do we go from here? And let's start with the stock piece of it. We think the stock market has already priced in a mild recession. So just as a reminder, people say, well, you know what, I'm going to sell my stocks and I'm just going to wait for everything to calm down. This is crazy, everything going on out there. And while that's a very human way to look at it, the stock market is a forward-looking entity. And so when everything, quote unquote, calms down, the market has already made its move higher. So with that being said, the stock market typically bottoms prior to the bottom of a recession. And we think that a mild recession is already priced into what the market is thinking over the next 12 to 24 months. The main headwind for the market continues to be how aggressive will the Federal Reserve be, or when will inflation start to roll over? The sooner the better from a standpoint if you're rooting for a higher stock market. And just the longer it's dragged out, the more kind of volatility, uncertainty that we think you will see here in the coming weeks. But we're optimistic, and we've been writing about this since actually the late spring, early summer. We think sometime in the fall time frame, you'll start to see inflation roll over. That hasn't proven to be the case just yet, but as you can see, I have a vest on. This is the first day I've gotten to wear a vest. So fall is just now starting, and still have a number of months to see if that does play out. Kind of on the same thought, where do we go from here? When we look back at history, the fourth quarter of a midterm election year is a positive quarter, or a positive last 3 months of the year for the stock market. That's historically speaking, that doesn't necessarily mean that the next 3 months are going to be positive this year, but it is worth mentioning. And then you look at, and we have another blog coming out, I think later this week, maybe early next week, on this topic. But when you do have a drawdown of this nature, the following 6, 12, and 18-month periods, historically speaking, have been positive. We like to say here at the Price Group, history does not repeat itself, but it often rhymes. And so we're big students of history and how markets have performed in similar periods in the past. So with that being said, we are optimistic over the next 12, 18, 24 months, but our crystal ball is a little bit fuzzy on the timing and the days, weeks, and 1, 2, 3 months here in the immediate future. So will there be a higher move in equities? What you're seeing is companies that pay dividends are continuing to increase those dividends. We think that's a really good sign. Like we mentioned earlier, a big piece of that is just with all the cash that these companies have on their balance sheets. Buybacks remain positive. You can see higher levels by almost 25% from before COVID. There's some new legislation where there will be a tax on these buybacks. And if that's the case, if that everything is finalized and approved, we would assume that you see probably a slowdown in buybacks and more of a transition towards paying shareholders back through dividends. But a little uncertainty around that, nothing finalized on that front yet. And as many of you know, we're big believers in dividend stocks. So this year, dividend stocks have had less volatility than the overall market. That's true on the upside, meaning our dividend stocks typically underperform when markets are moving higher. And the same philosophy, though, they typically outperform in a falling market. You see that here comparing the S&P 500 to just the S&P 500 dividend aristocrats.
Matt, one more thing on the dividend stocks. You and I have talked about sort of tongue in cheek. We turn on the talking heads on TV, and they say, "Well, how shall we invest during an inflationary time period?" And the answer has been, well, dividend stocks. They'll be able to raise the dividend. They've got healthy balance sheets, et cetera. Or how shall we invest over an inflationary period and a recession as well as that. And again, dividend stocks are talked about as that. We think dividend stocks, getting income is one of our secret sauces, if you will. And so we've sort of smiled as we see some of the other people now becoming dividend stock recommenders. Reminds me of the old country song, being country before country was cool. So anyway, there we go.
That fits Randy in a lot of different ways. He's wearing these gray New Balance shoes that many of you probably have seen. And there was a brief period in high school where I also wore the gray New Balance shoes, and he loves reminding me that he wore those shoes before I did. So he was country before country was cool in a lot of different ways.
Thank you, Matthew. So
Randy, tell us about the recession risk here in Europe.
Yeah, we think it's still best to be investing here in the good old USA with the majority of things you got going on. Obviously, energy is a big topic in Europe and will affect the economy there. So there are higher recession probabilities from the war and some of the efforts there. So we continue to favor the U.S. over Europe. Those of you that follow the U.S. dollar know that it's up about 15% versus a basket of other currencies. And so again, you see the U.S. equity outperformance. You know, at some point it's going to be good to own some the traditional diversification, but for right now, the misery index is much worse in Europe. Germany's trade balance turned negative, so we're going to stick with what's going on here. We feel like the U.S. right now is the cleanest shirt in the dirty laundry. So a couple other points here. Europe is dependent on Russian energy, natural gas, and it appears, you know, Putin is playing them like a fiddle with regards to he's hoping for a very cold winter. And, you know, the economy runs on energy over there, and natural gas prices have even soared higher than they have here today. That's the price per cubic foot. Look at that in the U.S. We think it's high at $7.75. Think what your electric bill would be if gas prices were 3 times as high. But the U.S. consumer is better positioned for higher cost, and that's a savings as a percentage of the 2019 GDP, U.S., Italy, France, and Germany. So again, some additional headwinds for Europe, and this will change at some point. For right now, we're very unrepresented outside of the United States.
So here's the you know, buy and hold is something you've heard. Our friend Warren Buffett, he has a famous saying. He says, "Neither I nor you are smart enough to predict where the stock market will be within a year from now." And so if Mr. Buffett is of the opinion he's not smart enough, we agree with him. We're not smart enough. And we even go out on the limb and say, you probably are not smart enough to do this on a regular and consistent basis. With that being said, here's what it looks like with some drawdowns over the past. So we're currently, as we sit today, between a 20 and a 30% drawdown this year. With a decline of 20%, you see a return rally on average of 25%, a 30% drawdown, you see a return rally of 43% on average. So once again, history does not repeat itself, but it often rhymes. And with that being said, we think, don't know if we're necessarily at the very quote unquote bottom of this pullback, but we think we have made it through the worst piece of it. And like we said earlier, the markets are pricing in already a mild recession sometime next year or maybe in 2024. So don't follow the herd. I'm reminded of the movie Lion King. The herd comes and tramples Mufasa. Don't be a part of the herd. And once again, Mr. Buffett here, be fearful when others are greedy and greedy when others are fearful. We have a blog coming out on the consumer sentiment where there's a third party that does this poll on a weekly basis, and it essentially asks retail investors, how positive or negative are you on the stock market over the next 6, 12, 18 months? And typically when the consumer is saying they're most negative about the future is the right time to buy stocks, and they have the best forward-looking potential rates of return. We've seen that number be its most pessimistic it has been in quite some time. That doesn't mean that the markets start to move higher tomorrow, next week, next month, but it does mean that the forward-looking returns over the next 12, 18, 24 months, statistically, historically speaking, should be higher.
So what's the one constant you can count on if you are an investor, and that is you need to have a written plan. We call what we do here at the Price Group our Live Well plan. Everybody wants to live well. Retirement's not an event, it's an ongoing process. Again, if it's not written down, it's not a true plan. We think of it as a retirement roadmap that helps you talk about how much you can spend during retirement, how long will your money last, what rate of return do you need in retirement, how do you invest your portfolio for increasing income, very, very important, inflation mitigation, extremely important now, and also principal protection. And Benjamin Graham, who was a buddy Warren Buffett, basically says the best way to measure your success is not whether you're beating some sort of market indice, but by whether you put in place a financial plan and a behavioral discipline, and they go both hand in hand, that's likely to get you there where you want to go. And so again, we come back to focus on the importance, the foundational impact of looking before you leap, again, what we call our Live Well plan.
And a big piece of that is developing your family index number. What rate of return do you need through a market cycle? Some years we may outperform that, other years we will underperform that, but we want this to be an average rate of return with good years in the market, bad years in the market, just okay years in the market. And we had a question from a client. He said, Matt, Randy talks about his comfort, confidence, and clarity. I'm not feeling that in this down market. And this client, who's a very astute individual, who we really enjoy spending time with, was really focusing on the bottom line of his monthly statement. And what we did is we went back to the Live Well plan. We went back to the family index number, and we looked to see, and in this specific case, his probability of success through retirement had not changed. And so we think the real comfort, confidence, and clarity doesn't necessarily come from just watching your investment statement, the value of your account, move up, move down, move sideways. We think it comes from having a bona fide plan And in hard markets like this year, trusting in that plan, using our Monte Carlo simulation, which many of you have done. So that brings us to our next point of, do you need an investment process? We think the answer is yes. Years like this are the reason for it. What do you own and why do you own it? We think income generation for any retiree should be a foundational principle. Retirement is all about income. Most all of our investment strategies are predicated upon that belief. And so with that being said, Randy, tell us about, here's a look at history, investing without an investment process.
Yeah, this is one of my favorite slides. If you look here, it's a little bit busy, but there are people out there that measure mutual fund and exchange traded fund flows. In other words, how much money are people putting into the stock market, the bond market? How much money are people taking out of the market, out of ETFs, out of bonds, out of stocks? And you know, the old adage, if you go to Walmart and toilet paper is on sale or toothpaste is on sale, typically you buy more, right? Because you'd rather have a good deal, buy low, sell high, is the old adage of how to be successful in stocks. But if you look here, the blue line is the 3-month net fund flows. And as you can see there, the black line is the S&P 500 index. And so at a period of time where the index, the S&P is down the most, you see people are selling the most, the little red lines around the 2 periods there. And if you would be a contrarian and actually bought at those periods when stocks really went on sale, you'd been much more successful, or even not sold, but just stayed in the ball game, if you will, doing that. And that's the same if you look at the flip side on the fixed income as well. What happens is many people, when stocks went on sale, they sold stocks, bought bonds, and again, two decisions at both much less than opportune times. So again, you have clarity, see where you are, know what your family index number is. It can lead to confidence, and that confidence, as Matt pointed out, leads you to be making better financial decisions. We actually, the people who study this have said when your emotions get involved from a small part of your brain, it really shuts down the logic portion of your brain and you act with just emotion. And typically, again, long-term people don't make good any sort of decisions, especially financial decisions, when they have a lot of emotion in the game.
Here's one of our favorite slides we've used in past webinars. We think dividend income really matters. Each one of these columns represents a different decade dating back to the 1940s. The blue portion of each column is the percent of the total return, meaning dividends plus appreciation or depreciation for that decade coming directly from dividends. So you can see from 1930s to 2020, 41% of the total return of the stock market has come from dividends, which is not a rounding error. We think that is a material figure. One could make a fairly compelling argument that over the next 10 years, the amount of return from dividends is actually a higher on a percentage basis if we do have muted stock returns over the next 10 years.
So live well planning is very important. It's the foundation of how we talk with and advise and counsel our family of clients. If you're interested, we set up a meeting. We'll guarantee you that the planning will give you some clarity, some comfort and confidence as it pertains to your financial future, which we think is really, really important. And again, that is what we think is one of the Price Group secret sauces. So we're very appreciative of your time. Matt, questions from the audience?
Don't see any. Shoot us an email if you have a question. Give us a call, and thank you again for your time.
That's Maddie, that's Tiffany, that's Randy, that's Matt, and that's Melissa. We are the Price Group. We're here for you. Again, telephone numbers and email addresses below. Thanks again for joining us. Enjoy this fall weather, and hope to see you next time on one of the Price Group webinars. Thank you very much.